Hello, welcome back to Making Money Manageable with Alan Dubsky and Juliana Jansen from Buffalo First Wealth Management. So we're going to again explore another topic that was brought to us. Sneaky ways your 401k could be sabotaged. I think we have this conversation once a week, actually. So it's pretty funny that somebody wrote into us, asked us to cover this topic, because there is a 401k leakage crisis. Economists have come out and said it in 2026, that 2025, there was record numbers of loans and distributions from retirement plans. And we thought we would do a video on why there is a crisis and what's disrupting retirement savings.
Yeah, and when we talk to people, when someone first comes into our office, one of the first things that we ask about is, do you have an emergency fund?
Mm-hmm.
And having an emergency fund is definitely underrated. It's definitely something that can give you the flexibility to manage your funds and your assets in the way that makes the most sense for you. So having an emergency fund available for car problems, housing problems, unexpected medical expenses can take the pressure off of your 401k and allow you to leave your 401k intact so that you could tap the emergency fund instead of your 401k.
The housing instability crisis going on in America with higher home costs.
Higher everything costs.
Yeah, higher everything costs, I guess. But as home prices go up, the deposits need to be higher. So you have to put more money down on that house to secure that property. So how are you going to get that money? So if the house is $200,000, they recommend 20% down so you don't have to pay PMI. That's 40 grand you got to come up with. And that doesn't include anything else. That's just the deposit on the loan to get that started. So some people call us up and say, hey, can I take money out of my 401k for this deposit? Well, if you can't afford the deposit, how are you going to afford the mortgage payment? Are you going to keep tapping into your 401k for those monthly payments to help cover that mortgage? So you got to really plan for what you can actually afford versus what the bank's telling you can afford when it comes to buying a house, whether it's your primary house or a second house. Really making sure, crunching those numbers, making sure that you have that emergency fund. And then how much can I afford to pay for that monthly payment? Forget about the deposit. What can I afford that monthly payment each month?
Yeah, and I think with the cost of housing increasing, it's getting more and more difficult. The temptation to up what you can bid for a house is pretty great, and it's definitely understandable. But sometimes the best thing to do is just to back off and either wait for the interest rates to go down or for a different, better, cheaper, more manageable option to come into your life.
I was always told if it's meant to be, it's meant to be when it comes to your forever home.
I absolutely believe that too. But the other thing that we're seeing too is with more and more people having high deductible plans for their insurance, large medical bills are another unexpected expense that are coming into people's lives. And that's another reason that we're seeing people feel like they need to tap their 401k. But there are definitely options. I mean, I know we've done a video on health savings accounts. Health savings accounts are a form of emergency fund, basically, where you can use those savings accounts to pay for those unexpected medical bills. And if you don't need them, it's not a use it or lose it situation. Those can just be carried out into the future. Go back and look at our video if you want to hear more about health savings accounts. But that's definitely another option to build that up so that you don't have to tap the 401k.
Yeah, and knowing what your high deductible is, I would venture a guess. I don't know numbers or I haven't done any research on this, but I would know that most people don't know what their actual out-of-pocket high deductible is on their health insurance.
I don't know that I know mine right now. I have a high deductible and I'm not sure that I think I know what it is, but I'm not positive.
I agree. I'm one of those. So it's probably close to 100% then because I'm one of those too. But another way that we see people tapping into the retirement plan is for education expenses. It was always told to me when I first started in this industry 20 years ago that somebody said you could take a loan for education, but you can't take a loan for your retirement. And sacrificing that compounding years of your balance in your retirement plan versus the compounding of your loan through your student loan, you got to weigh those options. You might want to think there might be better ways to take out for education, looking for private loans or different types of financing for education purposes.
Yeah, especially because, sometimes we see instances where parents are taking out a loan, and then after their kids get done with school, they're going to be in better shape than the parents are. So it makes for a sticky situation down the line, and you're definitely better off having the loan. Even though we're not big on high student loan balances,
Right.
It's better than tapping your 401k.
For sure.
But, I think one of the best things to do is to just run the numbers that are specific to you and really look at what your options are. So if you're finding yourself with an unexpected expense, whether it's a medical expense or whether it's something related to housing, there are definitely other options that are available to you, such as looking at a loan, a personal loan. If you have a health savings account, sometimes tapping your health savings account. But even if you don't, if it's a large medical bill, you can often negotiate with the medical providers to give you time to pay on that large bill. And that can prevent you from tapping into your 401k as well. We really want it to be a last option for people to tap because of the compounding effect, especially if you're younger. It seems like, I think sometimes we see people that are young thinking, well, I've got a lot of time. Those are the ones that are really going to be affected by removing those assets from their 401k, because you're losing out on years and years and years of compounding.
Oh, absolutely. And it never hurts to negotiate anything, actually. I know some people don't feel comfortable doing that, but sometimes, that uncomfortable conversation has to be done before tapping into your retirement plan, just so you don't sacrifice the rest of your life for just one time of taking that out. But it's never too late to save. Like you can continue to save into your retirement years. You can continue to save as you're approaching retirement. Just because you feel like you may have sacrificed some years, you can continue to save. Just make sure you're saving in the right spots. We see too many times where people, whether it's an emergency account, it's sitting in the savings account, getting next to nothing in interest, where we mentioned this in other videos as well. So like, share, and comment on our other stuff. But we talked about this before, looking for high yield savings accounts. They're still over 3% in a lot of places, that you could still be making money on your money to help build that emergency account even quicker.
Yeah, and I think people, when they realize that they're making a decent return, at least, it allows them to feel more comfortable putting it into an emergency fund so that they don't feel like it's just languishing, sitting on the sidelines.
And if you like our videos, like, share, and comment, and follow us for more.